With 7 days and counting now until the next Federal Open Market Committee meeting, investors are eyeing a 75 basis point rate hike with risk to the upside potentially. Some economists are calling for a 100 basis point rate hike following that hotter than anticipated CPI print yesterday. We did have PPI today. That wasn't as alarming, by the way, but the inflation data was a major headwind for risk assets as peak inflation talks now quiet down, at least for now. Joining us in studio to break down the latest market action is New York Life Investments economist and portfolio strategist Lauren Goodwin. Lauren, thank you for being here. We talked earlier in the show to Liz Ann Saunders, who talked about that maybe 100 basis points isn't happening, but maybe we'll get more 75 basis point rate hikes, for example. How are you changing or not your outlook for rates based on what happened yesterday?
Well, I agree with that perspective. I think we see clear evidence that inflation is nowhere near where the Fed would want it to be or even trending in that direction. I agree that 75 basis points is more likely for next week. It's plenty in one move, but risk is to the upside. Now, where I think the major changes that the market was pricing in yesterday, which I agree with as well, were for the November meeting, now 75 basis points very much in play there, and expecting the Fed to get to a 4% policy rate by the end of this year. Now, for context, at 8:29 yesterday morning, right before that inflation report was released, that was an April probability. And so this is a pretty significant change in interest rate expectations, which is why we've seen so much volatility in that 24 hours since then.
With the volatility that we have seen over that period of time, I mean, it seems like, as we were talking about even in the break, that the markets got caught flat-footed here. And so for investors out there watching, what is kind of the smartest idea that they can make with their portfolio in a time like this?
Well, keep calm is probably the number one most important thing to keep in mind. But the other is that even though economic risks are rising and even though we're seeing volatility, mostly to the downside yesterday, is that when inflation is this high, some of the traditionally risk-off or run-for-the-hills types of investment strategies can be a serious drag on long-term wealth creation, which is what most investors, especially on the retail side, are looking for. And so while we are moving more defensively in our portfolios, having just last week moved from an overweight equity position to a neutral one, that's still fully invested. And so then within that context, of course, we're very targeted and very tactical in our portfolios, but staying invested feels very scary right now, and it's one of the more important things to keep in mind.
To go back for just 1 second to the trajectory and pace of rate increases, can you sort of break it down for us? Okay, so let's say they get to 4% by year end instead of next April. What difference does that make, sort of in real terms, to the economy and the markets?
Oh, it's exactly the right question, Julie. And I think just as important as the pace that the Fed is moving and the change in that pace that we're all dissecting these past couple days, just as important is how long they stay at that 4, or now looking like more likely to be 4.25% terminal policy rate. And the reason that's so important, well, twofold. One is that sticking at a higher terminal policy rate is I think more likely than the market expects right now. We're seeing the market pricing in the probability of rate cuts in the second quarter of next year. I think that might be a little too optimistic unless we see some meaningful decreases in inflation and meaningful cooling in the labor market fast. So what does that mean? It means that there's more pressure on the economy in the medium term. But on the investment side, that's a really interesting opportunity for fixed income. If you have some stability from the Fed at yields that savers haven't seen in a really long time, there's some really interesting opportunities for entry across fixed income at that time.
We'd also seen, for all of the different categories that we were evaluating in yesterday's CPI print, it also comes back to, with a rising rate environment, where that's going to impact people's ability to buy homes. We saw in the home buyers data this morning, bids are coming down year over year at least. And so with all of that in mind, what other parts of the economy are going to see kind of longer term implications of a rising rate environment right now? And what does the average consumer need to know? Everyday consumer who might be looking at anything from groceries all the way to potentially buying a home.
Well, for home buyers in particular, one potential area of comfort, although not immediately, is this is a leading indicator of what's happening in the economy. It's one of the most rate-sensitive sectors of the economy. We tend to see housing lead us into a recession, but also lead us out. We've already seen a lot of the pain in the housing sector. Doesn't mean there's no pain to come, but just to say that that's early. What tends to come next? Well, we start to see next margin compression. We're already there, and then earnings revisions in the economy. Now, that's really important for equity investors, but for everyday people, it's also important because that's when you're going to start to see layoffs potentially, when companies are seeing their earnings fall. And so that's where then, of course, the average household looking at potentially up to 3 million jobs over the course of the next several months, more likely to be lost as the economy slows.